Hello and welcome to the latest Insider interview. Our guest today is David Coombs, who is Head of Multi-Asset Investing at Rathbone's Funds. David, thank you very much for coming into the studio.
Thank you for having me.
You've been in the industry for more than 40 years now.
Thank you, yeah.
You're still here.
Yes.
You must be doing something right.
Hopefully.
What lessons have you picked up along the way about investing?
Oh, crikey, how long have we got for this video? I'll cover a couple of points. The first is that you need to rely on yourself and back yourself. I think a lot of the time I've been distracted by people who I think are smarter, and they probably are smarter, but there's a lot of smart people, there's always a lot of noise, a lot of competing views, and how do you make sense of all of that? And so what I've done, and this is going to sound slightly odd, but I read a lot less. I stopped reading the Financial Times. I stopped reading a lot of analysis because I just got confused and started just looking at what's going on around me more directly, actually, the white pages rather than the pink pages, and what's going on in the real world and how the world's changing with social media risk and how trading and the rise of algorithmic traders and the thing you learn is you never learn it. The market's always better than you are, and you've got to learn that humility and drop the arrogance. Yes, you've got to be confident, you've got to back yourself, but ultimately, forget the hubris and then back yourself and be patient. So let me give you a great example of, I learned to my cost was, this is going way back now to 1999 when, or even before that, 97, 98, 99, when the first tech boom was happening and valuations were literally going to Mars and back, and we weren't even looking at price earnings multiples. We were looking at non-profitable businesses on price to sales sky high, and everybody was ringing up saying, why aren't you buying this, buying that? And I was a value investor back in those days. I'm more growthy these days, but then I was more value driven and in my career. And I was looking at these valuations and I was like, I just couldn't understand where we were going. It felt ridiculous. Some of these companies didn't even seem real. And then in 1999, having stayed away from a lot of them and underperforming, I capitulated and started to buy some. And I was still underweight, so it wasn't a complete disaster, but I got sucked in. And that was a really valuable lesson in that if you're going to get things wrong, do it because you've done it because you believe in it. Don't just follow the herd. Because most often the herd is wrong. And even this year, if you look at what the herding has happened, we've talked about Magnificent Seven in the past, this AI theme we had at the beginning of the year. And in the second half of the year, we've had the weight reduction drugs narrative. Those two narratives have really driven huge short-term share price movements. And what I've learned and what I've done this year is to just stay calm and stay out of that and look through it and take advantage of the volatility that these narratives create. And ultimately, as I say, don't get trapped in thinking everybody else is smarter than you, even if they are.
So the weight loss drugs and AI, big themes at the moment. You're trying to ignore the noise and follow what you believe. So what do you believe with regard to these topics? What are you investing in?
So AI, I think, is a huge, is going to be a seismic change, right? It's going to be almost like, to me, I would equate it to the internet being invented, right? Now, AI has been around a while. I mean, a lot of companies we talk to have been using AI to improve productivity for the last 5 years or so. Even companies like Rent-A-Kill, for example, use AI. So this is not new. So number one, it's not new. It's like it just suddenly got invented because of this Google Plus or whatever it was called came out. I've forgotten the name of it now. So AI has been around a while, so it's not new. Number one. So number two is it's going to have a huge impact on productivity, particularly in the white collar. So I would, if you think back to the 70s, 80s, 90s, well, you probably can't, but I can, when a lot of blue collar industrial jobs were lost to robotics. And in manufacturing, a lot of jobs were lost to technology. I think we're going into the white collar world, the professional services world, where jobs will be lost to technology. So it's almost like robotics for accountants and fund managers, dare I say it, but obviously, hopefully not. So I think it's really, really important, but the way to invest in it is to look at the companies that will be enabled. If you think about the internet, who made all the money? It wasn't those that developed the internet or run the cables, the Ciscos of this world. It was Google and Amazon, for example. They didn't design the internet, but they were enabled by the internet. They were the shops on the high street. And I think when you think about AI, you want to look at the companies enabled by it, and Adobe is one good example we hold that wasn't part of that Magnificent Seven, but subsequently the market's got quite excited about because it has its own AI function called Firefly. Turning to the weight loss, you know, I was on the right side of the AI trades. I loved it because we had 5 of the 7. We had Nvidia, for example, so it was brilliant. So great, ride it, take the profits. When it comes to the weight loss, we don't own Novo Nordisk, and we don't own Eli Lilly, which are the 2 biggest beneficiaries of their versions of those drugs. But again, the hyperbole around that was that everyone was going to be on it, and McDonald's would never sell a burger ever again. So you saw share prices in Coke and McDonald's. So a lot of the food manufacturers, producers, you know, restaurant groups, all losing money because all of a sudden no one's ever going to eat brown food ever again, right? And then all the medical technology companies' share prices got hit really hard. The diabetes companies that we own, like Dexcom, Abbott Labs, got hit really hard as well, and it was really painful. I mean, so you saw 2 major sectors of your portfolio, share prices legging down because of this hype that everyone was going to be on these drugs and we were never going to eat ever again or go to the pub, right? Now, you sit back and you go, hang on a second, really? You know, let's have a look at so we did a lot of analysis of all the test results and who was on the test and did they change their lifestyles? Did they come off it after so many months? What were the side effects? We did a lot of work around that to analyze it. And then Walmart came out and said, oh, we've lost a lot of sales because people on these weight loss drugs. Now, we called that out as technical term BS because it felt like CEO excuse land, and turns out it was because McDonald's and Coke have seen earnings in the last few weeks come out, they're better than they were before. So there is a lot of hype. There's a lot of, you know, people extrapolating this data to the earth and back again. And the point is, take a step back. Is it a thing? Yes, it certainly is. Should Novo Nordisk be valued bigger than the whole GDP of Denmark? I suspect probably not. That's slightly overdone. Are we going to get rid of diabetes in the next 12 months? I don't think so. So we've been adding to a Dexcom and Abbott Labs on that weakness. And that's the patient bit I mean. It's, you know, we always talk about we'll wait to add to our positions on a pullback. And when the pullback happens, there's a huge amount of negative noise. Oh, you know, should we do it? Because no one's ever going to get diabetes ever again. And I think we're being a professional with experience. You go, yeah, you're absolutely going to add to these positions because this is clearly overdone. There is some impact, but let's look at the materiality of it. So I think, long answer to your question, sorry, but that experience allows you to be more patient and to be a bit calmer and say, yeah, I've seen a lot of these stories over the years and they're almost always massively overdone. And often the winners aren't the ones that the market chases first.
Investing during a period of high inflation, rising interest rates, potentially a very weak economy next year in the UK, how do you go about that?
Well, it's really interesting because, you know, I sit around with colleagues and some say, well, when we get back to normal, you know, I'm like, well, this is normal to me. We've been here before, you know, through the 80s and 90s. I've worked through higher inflationary environments. To me, this is not that unusual, actually. I think people just get anchored to zero interest rates and zero inflation. Well, welcome back to the real world, guys. And I think what's interesting, and it's probably counterintuitive, is my cash levels in my funds is the lowest it's been for 10 years, even though I'm getting 5% on cash. Whereas 2 or 3 years ago, I had 15 to 20% in cash when I was getting 0 on it. And the reason for that is I'm finding lots of things to buy that I wouldn't look at 2 or 3 years ago because you weren't getting paid enough for the risk. My job is to look at any investment in multi-asset and am I being paid for the risk that I'm taking? And when I was earning, you could earn 1.5% from corporate bonds, i.e. lending to companies. That wasn't enough for me to invest. Now I can buy corporate bonds because they're giving me 6, 7, 8%. I've been buying bonds and not kind of, you know, highly indebted companies. NatWest, Coventry Building Society, not wildly exciting names, but yielding 6.5%, 7.5%. Then that's quite attractive. That wasn't open to me 5 years ago. So I'm buying corporate bonds. I'm buying government bonds yielding over 5%. I'm buying infrastructure, which I've never bought before, ever, because now they're yielding 10, 11%, some of those companies, because people have sold them off because they've fallen 30, 40% this year. They're quite distressed, big discounts to their net asset value. And so I'm buying them because they're distressed assets. So what you're seeing is, as inflation has risen and interest rates have risen, some asset classes that were pretty benign for the last 15 years have suddenly had a leg down. I guess the obvious ones are commercial property, and even sort of residential property market's been off a little bit. I'm not ready to go into commercial property yet because I think there are other structural problems there, but certainly we're buying a lot of areas where they've fallen a long way because of these interest rate rises, and because we think we're near peak interest rates, these very cheap areas look quite attractive to us now. So we are not short of things to buy, and that's that. Whereas other people are selling because they're worried, I'm buying because I think we're near the worst of that.
We're heading into 2024. There's a lot to digest in markets at the moment, but you've got a very low cash level, so you're obviously feeling quite bullish. What's your outlook for the next year or so?
So I think the first thing to say is my cash weighting does not reflect my bullish or bearishness. So I'm Welsh, so I'm always bearish. The cup's always half empty. And again, being a multi-asset manager, you're always focused on the downside, actually. I spend most of my time worrying about the downside rather than the upside. So I wouldn't say the cash position reflects my bullishness. The cash position reflects the fact that I think there are a lot of asset classes where you're being paid to take risk. Now, when we get paid for that, is it in 2 months' time, 4 months' time, or 12 months' time? I don't know the answer to that. It goes back to my point about being patient. But I'm really confident that I will be well rewarded for some of those investments that I'm making now. And so I'm bullish about the potential rewards. I can't say, is that 3 months, 6 months, or 9 months? I think it's probably 6 to 12 months. I think the next 6 months, is always very difficult to predict the immediate future. Clearly, there's a lot of geopolitical risk around at the moment as well. So, I think it reflects the fact that there's a lot of quality investments right now, not necessarily equity markets, but elsewhere, that is demanding attention to get into the portfolio. So I think, reasons to be cheerful, I guess, is I think we're near peak interest rates in the US. I'm almost certain we are in the UK, as certain as I can be. I think it'd be absolutely ridiculous to raise rates in the UK from here. And therefore, that kind of headwind that we faced for the last 18 months, that's out of the way. It's one less thing to worry about. I think the Chinese economy, which has been a really big headwind because it's been much slower to emerge from the COVID era. I think they've signed it slowly, and that they've got the property market under control. We'll see, But so I think some of the headwinds are starting to dissipate. Clearly, we've still got a war in Eastern Europe. We've got the situation in the Middle East at the moment, and we've got elections in the US and the UK next year. So, whilst I think, generally speaking, the macroeconomic picture looks more positive, there is still things for us to consider, not least, Donald Trump in the White House.
And what would be your number one fear then for 24?
I think an escalation in the Middle East would be my biggest fear from here. What we've seen already is, the oil price, energy prices react, although not as much as you might think. But were other countries to get drawn in, we could see a big spike in energy prices. If we were then to see, the big major powers come in, then clearly we're in even bigger geopolitical risk. The probability of that is, I still think, relatively low at this stage. Hence, we're not reacting. But you can't be complacent.
And finally, the question we ask all of our guests: do you personally invest in your funds?
I only invest in my funds. I have no investment outside my funds. So my SIP is in my funds, my ISA is in my funds, my wife's SIP is in the funds. She's my biggest critic. So I don't invest in anything other than my funds.
David, it's been great talking to you. Thanks for coming in.
No, thanks for having me.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.